remember, we have one more speaker after him, and we will make all this information available to you through recording and also share their offer links for you with the recording. If you'll just be patient and watch for that. And you can also find it on our website at tradethirsty.com in the next 24 hours. Dave, if you want to share your PowerPoint and then give me a hit audio test, I'll make sure that we're all good. Let's see. Yeah, let me make you the presenter again. It popped back to me for some reason.
Hey, Jeanette, how do I sound?
Hey, you sound great. Can everybody hear? Sorry about that. I was like, what's the presenter? Oh, wait, I am.
Yeah, no. No, I think it did bounce back. I had it for a split second, and I thought I didn't do anything bad, so...
I didn't either. I was sitting here and I went blip, and I went, oh, no, not today.
No.
Not today, webinar, not on my watch.
We are just fine. Thank you very much for that. And hi, everybody. I just, okay, it looks like everybody's telling me they can hear me, so I am ready to go. Let me just double check my screen.
Yeah, hang on, something just happened. What is it doing?
Yeah, it seems to be...
It's popping back to me. I'll tell you what, give me a second. I'm going to make you presenter again, and then I'm going to rename myself. Sometimes when it does this, if I rename myself, it'll stop doing this. I've
seen it do that before. I think we're good, because right now the audience can see the screen, so I think we're okay, unless it pops back, but... just yell at me if it does, anybody. So thank you again for having me, Jeanette. I really appreciate this opportunity. Hi, everybody. My name's Dave Aquino. I am the Stocks and Options Live Trading Room Specialist for Microquant, and our website is actually valuecharts.com. And I appreciate you hanging around today. I know it's middle of the week here, but I have some great information for you. I hope you enjoy it as much as I enjoy presenting it to you. It's called my 11-hour options spread strategy. Now, it is a strategy I utilize in my trading room very frequently every week. The idea of the strategy is to generate a consistent, respectable, and a relatively easy way to generate income on a weekly basis. And for our complete income trading strategy, the fundamentals expressed that I'm going to show you tonight in this strategy is actually, they're very consistent. And I think you're going to find them kind of a breath of fresh air, because I know a lot of traders, they're trying to get that consistent income in a way that they can understand the risk and to utilize some of the strengths that we can easily see with technical analysis, like momentum, support and resistance levels, and things like that. So without further ado, just let me go ahead and get going here. A really quick risk disclaimer. It's up there on the screen. I'm not going to read it to you, but the main thing that we want you to know is that we're presenting this information for helping you educate yourselves as traders and helping you make your own investment decisions. Please don't trade with money you cannot afford to lose, and past performance is not necessarily indicative of future results. Here's CFTC Rule 4.41. Basically, the Commodity and Futures Exchange wants you to know the same thing, okay? All right, a little bit of information about me. Again, my name is Dave Aquino. I graduated from Vanderbilt University in Nashville in 1995, and right after that, I became a general securities broker with Merrill Lynch for about half a dozen years. Right after that, I moved towards Philadelphia, Pennsylvania, and I joined the Vanguard Group. A lot of you know, or maybe even hold Vanguard Holdings. I worked in the asset management service in the ultra high net worth department. We managed monies for client households 25 million plus. My job was to take highly appreciated assets like IPO type stocks, holdings, and generate an income utilizing option strategies on that. So I've been doing this a long time. I've been with valuecharts.com for over 4 years, leading the stocks and options live trading room. So the ideas that I'm going to share with you tonight, I actively apply to the markets on a daily basis, on a weekly basis. So what I show you is what I do. And I have a room full of traders on a daily basis. And when we get down to doing our 11-hour option strategy, which is actually Thursday, tomorrow, we actually we have a packed house. So it's an exciting way to trade. All right, a couple of numbers I would like you to memorize because I'm going to quiz you on it at the end of the webinar. 95.8%. Okay, that's the first number. The other number is 5.44%. Okay, those will be the quiz at the end of the hour here. All right, so just as an introduction to the 11-hour option spread strategy, I'm going to talk on 3 main points because maybe you're not as up to date or as sharp on these aspects of options, but I'm going to give you a quick summary, and that way everybody's up to speed. The essential Greek of time. And then I'm going to talk about time decay and how that is applied to a weekly calendar. And then I'm going to jump into the meat of the presentation here. It's the 11-hour option strategy itself. All right. The first thing, the essential Greek of time. This is the Black-Scholes option pricing model. I pulled it from a textbook. I honestly don't know what a lot of those calculations are. But basically, it's talking about the value of a derivative, something that is based on the value of something else. Now, when you're talking about options derivatives, you have aspects like what is the current strike price? How much time until expiration of this particular option? What is the implied volatility of the option? What is the volatility of the stock? What is the risk-free rate of return? The numbers that primarily we're interested in is called theta. And theta describes the option's sensitivity to time to expiration. Now, the way you can visualize this, and I will show you also in a later slide, this is time, and this is money. And if it's an at the money or out of the money option, it actually decreases geometrically to the point it gets to 0. Okay, and this is an expiration. Okay, if it expires what we call out of the money or at the money, there's no value to that option because it is not in the money. The most important fact is the fact that it does this curve. Okay, it goes down in value. So it's kind of like the idea of when you buy a new car, you drive it off the lot, and you drive it down the street, and now that $50,000 car, you can't turn it around and sell it for anything more than $48,000. All you did was drive it down the street. Well, you buy an option, that has 5 days left of until it expires, and then nothing happens to it today. Market closes. You come back the next day and you look at the value of your option. You're like, why did that thing drop? The price is exactly the same, and the only reason why that price dropped in value, the value of your option, is because time passed. It accelerates as you get closer and closer to the deadline, to the date of expiration. Again, this is basically the long way to say, as it gets to approaches expiration, it increases the rate of loss due to time decay. Now, I primarily trade weeklies, and for something that you buy it with 5 days out, the greatest loss of value due to time decay is in the last 1 to 2 days. Now, option sellers, when we're selling premium or time, use that to our advantage. It's almost like that dollar you lost in your option, when in my example, well, that money went in my pocket because I took a risk. Time passed. Well, now I can buy it back from you for $4 because that's what it's worth. So that is me making profits based on time decay. Okay? That's the concept that I want you to understand. Here's a brief example. This is 90 days out, and it looks like it's worth about $5. Okay, provided say price doesn't even change. Here, 60 days out, it's worth 4. 30 days out, it's worth 3. 15 days out, it's worth 2. 5 days out, it's worth 1, and 5 days later than that, it's worth 0. Do you see how the first 30 days you lose $1, second 30 days you lose $1, but then 15 days you lose 1, 10 days you lose 1, 5 days you lose 1. So it's accelerating the rate at which time is affecting the option. So for me as a seller, I make most of my money here. That's the greatest change. Okay, does that make sense to everybody? Any questions? The concept is make money because of the passage of time. Now, what does this look like on a weekly calendar? Again, a weekly calendar, let's just say the trading week starts on Monday, ends on Friday. So that's 5 days. The greatest loss of value of those options in the last 1 to 2 days. So that is Friday and Thursday and Friday. Now, again, we're trying to collect that premium. So the day that we actually put our 11-hour option trades on are Thursday. That's when we do it, because we want to capture that transition from one day to the expiration day. That's the greatest rate of loss in this particular strategy. Okay, you can see it on how we laid it out on the week. There, 11-hour options lives from Thursday into Friday. That's pretty straightforward. So once you understand the weekly calendar, and you know we put the trades on at the end of the week, how does the strategy now work? So let's go ahead and get into that. Now, when I formulated this strategy about 2.5 years ago, there's some parameters that I wanted to fulfill. Now, the first and most important thing is high quality, high probability trades. I want to have winners 80% of the time or more. Okay, that is the first criteria. Second criteria is the fact that I want to be in the market as little as possible. Now, it's fine when the markets are not moving, markets are steady, but when you have a market that's going like this, you know, spike here, spike there, goes up like that, you don't want, it looks like a heart rate actually. That's what, you don't want to live through that, because you'll get thrown about just like a boat on a stormy sea. So we want to be in there as little as possible. We put on these trades right around noon, maybe a little bit before, a little bit after, and we manage the position until the 4 o'clock close on Friday. The trades are primarily based on a daily chart and a 60-minute chart. Those are the time frames most traders are most familiar with. Daily, definitely, but 60 is a very unique way to look at the market because you get to see inside this daily bar. So it definitely does help. Now, how do we evaluate a good trade? Well, we're looking at a chart that shows that the current momentum has strength and direction. This is important because those of you that have option experience, don't most people say, well, you buy something that's delta 20 or delta 15 and you buy it back when it's delta 5. Okay? My question is, do you know which way this market's going? Is it going up? Is it going down? I don't know. I just do the delta. I said, but you have delta at the top and delta at the bottom. Which one do you do? Are you bullish or you're bearish? It doesn't matter. I will surely be the first one to tell you it matters significantly. And I will show you some charts in a little bit. But the first item is what is the current directional momentum of the chart on those daily and 60-minute charts. Are there support and resistance levels? Are you running into the weekly high or weekly low? Are you looking at, you know, an all-time high or all-time low? Those are different aspects of how price moves, and price surely, especially on the daily chart, pays attention to support and resistance levels. Now, so a lot of the trades that we take tend to, you know, when they move like this, there's Fibonacci retracements. They move higher, they pull back. They move lower, they pull up. Okay? Markets never go in a straight line like this. I've never seen one before. They go up and they go down, and they go up and they go down, and they go up and they go down. So you know that, and you know how far it may go based on Fibonacci. Now, the goal of this strategy is to generate overnight income. Okay? I'll show you what I mean. But now, when you look at a chart, what is the first thing you're doing? You probably look at it and say, hey, that chart's going up, or that, wow, Tesla's falling. You know, something like that. Now, that's great. You see a chart going higher. What do? Guys, what do you do when the stock is going, let's see, price is going this way? Okay, that's a chart. Bottom left, top right. What do you do? I'm also testing my questions box. Just make sure you guys are good. Option trader Eric says buy a call. Like it. You can buy the stock. You can buy the call. You can sell a, yeah, you could sell a put. You could do that. Okay, so you get into a bullish trade, right? Well, that's not what I do. Okay, so I see it's going this way. Let me just clear this screen. Guess what? If this is going up like this, I'm going to sell down here. Okay? This is the price level where I will sell. Why? Price is moving away. When you focus on selling premium or selling spreads, the short strike, this is what we call short because we're selling it. We want it to be away from the projected price direction. Have you ever seen the kid that's running on the playground? He's got the football and everybody's chasing him and he's running away as fast as he can from anybody that's trying to, squish him into the ground. Yeah. See, I have kids, and I have very fond memories playing with my kids, and I had a really good childhood. So a lot of my analogies go to simple games and its occurrences that we can easily visualize and understand what's going on. So while this kid is running away, he can see that the big people are running this way. Well, guess what? He's going to turn around and run this way. This is where I want to sell my premium, down here. So I want to be where prices will likely most likely not be at expiration, which is 4 p.m. on Friday. Okay? If I can stay away from price and I can keep my premium and keep 100% profits. So I hope that makes sense. So again, profits primarily come from this strategy through theta decay. Who here believes time moves forward? You can raise your hand. Me? Yes. I've never found a way to make time go backwards. Now, if I'm selling premium, time is always positively adding profits to my account. Okay? There's no way for theta to move backwards. If I have a theta position that's positive theta, the more time passes, the more money I get. And the nice thing is when you go from Thursday to Friday, there's an overnight time decay that you can take advantage of. There are some days where price never changes from Thursday to Friday. The market opens and all of a sudden my positions jump 20 to 25% for doing nothing, just sitting there. Okay, so again, that's overnight decay of out-of-the-money option spreads. Now, what I'm trying to do on a very consistent basis, and you guys got to hang on with me here, is generate anywhere from 4 to 6%. That's it. 4 to 6% per week. That means I want to get anywhere from $40 to $60 per $1,000 risked. Okay, that seems like a pretty good trade-off, right? 46% per week, $1,000 risk. Now, okay, now those of you that ever sold premium or credit spreads know there's a larger than average risk if you just leave it alone. What we try to do is if we're going to try to make $100, okay, that's how much we're willing to make. Maybe we have a couple of these spreads. $100 is what I'm going to make in a week. The most I'm willing to risk is $200 loss. Okay? That's what I try to do. And now we have strategies for risk control. But those of you who have ever sold a credit spread know that that is a very reasonable amount of risk, because you'll see that risk reward versus win rate versus loss rate really works in our favor here. Okay? So this is what we try to implement ourselves. Okay, let me take a quick step back, make sure you guys understand this. This is what I mean by selling away from where price is. Now, this is Google, okay? I mean, I apologize if this is a little old slide, but it demonstrates it so well. Price is coming down. You make this first low right here. And then we make this little move higher. That's okay. And then it gives it on the second try. It tries to go down again. Now, that's just the price. This is my momentum indicator. You could use MACD, but the thing is, this histogram bar, you see how big and red they are? Actually, belong to this low. The second low, which is actually a deeper low, you see the momentum, it's much smaller. And that corresponds to this. We call this a bullish divergence. Price is actually the same or worse, but the bearish momentum is actually less. So there's a tendency for this price to move higher. And you don't have to catch the bottom exactly. That's not what we're trying to do. We can actually take a look and say, you know what? Price is making higher highs. Look, momentum is going up. It's actually very easy to see. So if all the big guys on the playground are running this way, where are you going to run and hide with your football? Down here. Okay? Down here. So I'm going to sell a credit spread with the short strike at 845 by 840. Okay? If by 4 o'clock on Friday I don't reach 845, I keep 100% profits. I get that 4, 5, 6%. Does that make sense to everybody? It's the concept that's important. It's keep away. That's all. You read momentum, you read direction, and then you say, okay, price is going to have a really hard time to get down here. Because in order for it to get to me, it actually has to turn around, go through this support level, which is based on this high, okay? Goes down to this support level because it's based on this pivot low, and then has to get through 485. Why? Because of this pivot low. So not only do I have momentum in my favor, but I have support levels here, here, and here. Don't worry if you don't understand all of that concept, but it's something that I teach in the workshop. It's practical trading. This is stuff really works in the market every single day. So this is where I sell my premium. Pretty neat, huh? So it's not based on this is Delta 20, just sell it. No, because I can read where it's going. Okay, I'm not going to stand up here and sell it because I see that the big guys are running towards it. Here, in order for it to actually come and get me, it has to turn around to 180 degrees, get through 3 support levels, and there you go. Okay? Very, very good. All right, so these are more examples. This one I wanted to show you. This is a channel. Okay? And we get a little bit of a head fake here, and then all of a sudden what do? We break to the downside. What's momentum saying? Well, momentum's falling off the table here, okay? So where do we sell our credit spread? How about we sell it up here at this price level, maybe 535 by 540 or something like that. The point is, it's already running away. We can see it. Let's do our credit spread here. That's where we want to do it. Okay, it pays to understand where price is going and then where's the safe zone. Okay, same sort of things. So coming back to the 11-hour option spread strategy, you can see the mental framework under which we pick trades that look good to us. So how does that consistency come out in terms of the goals that we've set forth? Okay. All right, so first thing we want to do in this strategy was we want consistent winners. We're talking 80% or higher. We want consistent percentage gains, 4, 5, 6%. And we want to have a very strict risk control that is very conservative. Okay, so let me ask you this. Can you make money like this? Small gain, small gain, small gain, big loss. Small gain, small gain, small gain, big loss. Okay, you can't make money that way. How about this? Small gain, small gain, small gain, small gain, small gain, little loss, small gain, okay? You want these gains to keep powering higher. It's almost like a march of ants. You know, you take, or a consistency. You get 2 steps forward, 1 step back. 2 steps forward, 1 step back. You make progress that way, but it's very hard. How about 5 steps forward? How about 6 steps forward and half a step back? 6, 7, 8, 10 steps forward, small step back. Think about it. That's what we call progress. All right. You know what? Let me jump over to, I forgot this slide was here. I think this is, I'm glad this is here. Remember the numbers we were trying to aim for? 4 to 6, right? 4 to 6%. You know, let's just say that's kind of like a pie in the sky, you know, too good to be true. Let's go down to earth and say, okay, 3%. If you go for 3% per week in terms of overall return, and let's just say maybe commissions, after a month, which is after about 4.3 weeks of trading, is what it comes out to. That kind of returns a 12.5%. That's no joke because it's compounded. All right? So if you're looking at a chart where we start with $10,000 and you're going to do this over 52 weeks, okay? You compound it 3% a week, you actually come up with this crazy number. That's 3%. That's not 5. That's not 4. That's 3. Okay? Your 10,000 goes to 46,000. Okay? And then you can carry it forward and carry it forward all you want. I'm just saying to go from 10 to 46 at 3% a week, let's just say you're not as good a trader as maybe you could hope. And the result is you could take some losses. You go from 10 to 28. Isn't that still a pretty good way to trade? I mean, it really makes a big difference. If you're basically tripling your account every year, that's an extremely consistent way to trade. I actually have traders, what they do is they divide their account in half, into a third, and they trade with just a third of their account, and they're aiming for this number. So if you're trading with a third and you triple it, you're basically doubling your account every year while keeping a lot of money on the safe side. Think about it. Doubling your money every year is a very, it's very conservative, to be honest. Okay? All right, so let's go back at these goals. Now, I apologize. This is a little bit dated, okay? But I'll see the numbers and I'll let you know, okay? Because we did this at the end of last year, and I know I updated the numbers, but I think I grabbed the wrong slide. So anyway, let's talk about year-to-date. I think this is through 3 quarters. All right? Yeah, this is through 3 quarters. We want consistent winners. In this 11-hour option spread strategy, we had 123 wins over 127 trades. The losers, that's 96.8%. I know I remembered now. Okay, so 96.8% through 3 quarters. We want consistent percentage gains. The returns we got last year, over 5.5% per week. Okay? And those losses that we took, this is that strategy. If you're going to make 100, the most you're willing to lose is 200. We had 2 of those losses. And the other 2 was, okay, so we're trying to get 100, okay? And then close to expiration, we're almost at maximum profit, about to get to 100, and we move our stop loss. Not so we lose 200, but because if we go back and we make 0, that's a break-even stop. So in these 2 trades, it was 0 loss, 0 gain. I'm more than happy to give those up anytime, because as if I never did the trade. Okay? So think about it. That was the goals for last year through the first 9 months. That's what we did. Now, one of our traders at that time sent me this email, and it's kind of like a testimonial. His name is Gene. He really got into the 11-hour option strategy. Let me read it aloud to you. He said, I love your 11-hour trade strategy. Over the last 6 weeks, I've made 38 trades without a single loss. That's not me. That's Gene. These are now my bread and butter trades. Thursday is my favorite day of the week. I practiced your techniques for defending the trade, and I paper traded until I had the confidence to start live trading. That's important because I advocate that, because you need to get the mechanics down. You need to get familiar. How does it move? How do you set your stop loss? What do you do? And then you can easily increase the size. I always tell my traders, start with 1 spread, one contract per trade, and then build into it. Okay? He said, I practiced your techniques until I could get the confidence to start live trading. My trading results were mediocre over the past few years, and I'm very excited about finding this strategy. It is a consistent winner. I only wish that I learned about your 11-hour option trades earlier. He said, please feel free to share this information. So Gene he's still in my trading room. He's still trading this strategy. And the thing about it is a strategy that's extremely consistent and repeatable week after week. Gene actually, he calls it his bread and butter trades. Guess what, guys? I have my traders, they actually call this their paycheck, okay? Paycheck trade. That's what they get. Friday, they cash out, they take their money home. That's their paycheck. That's the way they see it. Okay, so again, this is how the actual numbers stacked up through August. Okay, now basically what it is this, and you can look at the numbers and definitely see this. This is the average weekly return for each week in January. That's why I multiply it by 4. Okay, the $10,000 we started with. Okay, if you multiplied it out and subtract a little bit for commissions. Okay, I'll be first one. So everybody has different commission rates, so subtract out 1%. But that 10,000 in the first month goes to 12. Okay, in February we did about 4.5 average every week, and that 12 goes to 15. March, good month, 5% on average times 4 weeks. At 15 goes to about 18.5. The next is April. April does about 4.85 a week. That 18 goes to 22. May, we go to 4.5. 22 goes to 26.5. Now, June was a blockbuster month, really good. 26 goes to 35. And then July takes some of it back, 3.3, and that 35 goes to 40. And then here, August is a good month, 6 and the third percent, that 40 goes to 52. So roughly, you go from 10 to 50 over the course of 8 months. Okay, no fooling. That's some good stuff. Okay. Now someone's asking me, do you have any more recent reports? Let me show you this. That time period that I was kind of talking to you about last year, Gene was not fooling you. Gene actually was in a time period, and if you look at this time frame, you see this is May 15th, 2015. I am actually doing a live mentorship program right now with a bunch of 11-hour option traders that really are working to refine this, because we go from basically the middle of May to the end of September, and we do not have a losing trade. We have over 50 plus trades. Gene was like right in the middle of it. So here's the case. Here's May. Here are the actual trades that I took. Here's the return. This star means I did not get filled. Okay? Okay, here's May, but that trade actually came out positive anyway. Here's the second month of May. 5.4% return for the week. Here is the end of May, 3.7. Okay, here's June. June, we did 5 the first week. Second week, 6.4. End of June, 11.6. The reason why 11.6 is so high, this is actually an iron condor, by the way. Okay? I've actually refined that strategy. We do it a little differently, but this week, this is definitely a successful week because of that iron condor. 11-hour option trades. Okay, that's June. Here's July. Okay, 5.93, 7.28, 5.53, 4.8. You know that saying, sell in May and go away? I think that's kind of foolish. I think the early summer period, moving May, June, July, August, extremely good for income trades. Extremely good. Here's August, 6.75, 6.32. These are actual trades that we did, folks. Here, 6.25. This is actually a week that we actually pulled back. If you go back to August 15th, August 2015, this is the market's falling. That's why we're all bearish here. Most of the time we have a nice combination. Bullish to bearish, sometimes bearish, sometimes it's even. Now, I want to get to the one where we lost, so you don't think I'm pulling your leg. Here, that's balanced. Here, this is balanced. See that? We make 6%, 5.2%. There's the loss. That's the end of September. Right there. Okay? End of September. We only do... This is the cool thing about this trade. If you manage your risk, okay, we have 4 trades. We took a loss at 2 times the maximum profit we were trying to get. I got it out a little bit early. But guess what? We were still positive on the week because this is the loss. This is a gain. This is a gain. This is a gain. Oh, net, I think I still made, I'm not going to do the math right now. Probably $750. That's what we made this week. And we still came out with a positive even though we had a loss. That's some diversification, but it's also primarily risk control. Okay? The next is, you want to see what we've done this year? Give me a second. Let me see if I can find it. Sorry about this, guys, because we're actually using it in our trading room right now. Oh, that's not it. That's not it. Sorry, I have a lot of pages here. This should be it. Yep. So, again, we are looking at this year. So that I showed you last year. This is this year. And I'll be the first to tell you, had a little bit of a bump right at the beginning of May. We actually utilize a strategy now. We're evolving our income trading strategies. We use a strategy called delta neutral trade, so that when sometimes an 11-hour option trade goes against us, we have the ability to neutralize that that position. And we utilize, in this case, you know what, these are not calls, these are puts. And we optimize the position, so not only in most cases we neutralize the loss, but in some cases, in this case, you make a little bit of money, you actually come out positive. That was the first week of May. Here's the second week of May. We do what we call a midweek 11-hour option trades. Remember I was showing you that expiration happens on Friday? Well, they're kind enough to put a midweek expiration on options. So we do 11-hour options not only on Thursday, but now we also do them on Tuesday. So we say thank you very much. We're happy to come in and get 5% on our money. Okay? Here's the ones from the 13th. I'm showing you this because remember that summer that we had last year? This summer is supposed to be even better. Okay, here's so far, May 13th. Profit, again, a little bit of delta neutral position. Here too. And then profit and profit, you know. And then here is the one that we did last, this is an iron condor. We actually have a midweek iron condor. We put the 11-hour trades with this trade, and we actually do very, very well. Okay, here we go. This is last week. This is Friday. Okay, 11-hour. This is 11-hour option trade, 11-hour option trade, and then an iron condor. Okay. Again, the summer of fun has started again. That's what's so exciting about the way we trade these. Okay, that is the 11-hour option spread strategy. This is what I'm offering you today. Okay, I'm so excited because the markets are doing very well. 11-hour option spread strategy is a workshop. It's an on-demand workshop. It's available to you right now. You go and you watch it. It's about an hour and a half. You'll get it. Tomorrow's Thursday, folks. Anytime it's Thursday, it's like a good day because that's the day I can put my 11-hour option trades on, manage it to Friday, collect my weekly paycheck. Because this workshop will teach you how to make a full-time weekly profit by being in the market 1/3 of the time. Going to teach you how to make a consistent high probability income just 2 days a week. That's what I mean by this. So you work Thursday, you work Friday. And I advocate that you actually do work. But after that, you cash out. You don't have anything to worry about over the weekend. You have Monday, you have Saturday, Sunday, Monday, Tuesday, and Wednesday. Trust me, if you work 2 days a week, you're going to get bored by the time you get to Wednesday, okay? You can trade this strategy as a set it and forget it. I'll be the first to tell you it's not as effective. You can put it on, get filled, put your stop losses in it, leave it alone. There's an ongoing, way to keep learning about income trades, and we have traders that combine a lot of stuff. Like that iron condor I'm showing you, that's the big kind of new jump that we can do in our trading. But again, 11-hour options can be traded as set it and forget it. The workshop contains a very detailed step-by-step method to optimize where you sell those strike prices. Remember I showed you the chart that you just need to know where the price is going and where your protection is. Okay? If you can do that, you can really increase the success rate of what you're trying to do. Okay? And then, just as important, is that risk control method that generates long-term profitability. This is not a put your money in and you're going to multiply it by 100 by, 6 months from now. You really don't want one of those strategies. Even if you're multiplying your profits, you're getting 2 times, 3 times, 4 times, you are nervous as anything because you're worried that the market will take it back, that it's abnormal, okay? And really, you cannot create a consistent income methodology based on home run hits. You just cannot do it, okay? So keep that in mind. We want to generate long-term profitability. Now, you want to understand this trade setup and let it run profitably 52 weeks a year. Really consistent traders that make a living in the markets want that trade setup that they can go to time and time again. This thing can run week and week and week and week. Think about this. I'll tell you my favorite week to do this trade. The favorite week to do this trade is Thanksgiving, because everybody knows Thanksgiving's on Thursday. We put our 11-hour option trade on Wednesday. Okay? It's Wednesday at noon. Ask yourself, what were you doing Wednesday at noon last Thanksgiving? Okay? What were you doing? You are probably getting ready to go to grandma's house. You're trying to tie up stuff at work, go to grandma's house. You know what I was doing? I was putting my 11-hour option trade on. And I got actually a couple of good ones. What does the market do Thursday afternoon? All those fund traders have left to go to the airport to go to grandma's house. The market stops. It stops moving. What happens Thursday? You're enjoying Thanksgiving with your family. What happens Friday? Half the people in the country that actually go to work on Friday do their shopping Friday from the computer. Nobody's working. All the fund managers are still at grandma's house, and they're telling all the junior executives, don't do anything stupid, don't move the market. So they do that in the morning. Why? Because 1 o'clock in the afternoon, everybody leaves, early market close. So I'm in the market when it's completely dead for about 7 hours, and I make 6 or 7% on my money. I doubled the size of the trades I do Thanksgiving. And I easily walked out of there trading about a $30,000 account, and I probably committed about $20,000 to the account. I walked out of there with over $2,500. I did about 7%. I did 7% in a market that was completely dead, and all I did was enjoy my Thanksgiving with my family. Keep that in mind. You know, do this every single week. Okay, the link, I'm going to go ahead and put it on there, but I'm going to keep showing you a couple of more things here because I just noticed I still have some good time. So you guys feel free to ask some questions. 4 times, I'm sorry, I just saw your question, Ricker. That 4 times when I was showing each month, that was the weekly return, and there's 4 weeks every month. So it was like multiply it, multiply it, multiply it, multiply it. Okay, so that's sorry I missed your question. All right, so that's the essence of the 11-hour option strategy, okay? You go to valuechargetrading.com. It's there in oh, you know what? I need to send it to everybody. And let's see if I can get everyone. Okay, so you see that? It goes valuechargetrading.com/11. That's where you want to go. You just click on the link there. And you'll come to a page that looks like this, because surprise, 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 it is $50. Guys, $50 won't get you to take your spouse out for a nice dinner anymore. But you take that one investment of $50, and it shows you a strategy that you can apply to the markets every single week from now until eternity, because they're never going to get rid of options. They're actually trying to figure out ways to do more option contracts. That's why they do this midweek strategy now, okay? And it's designed to be very consistent. Remember, there are a couple of numbers I asked you to... Oh, this is what somebody asked. What's the 4? Remember this return? This was 8 months. Now, I can't promise you this is going to be exactly the same number, Okay, these are not numbers that are, they're not telling you I made 475%. Okay, how much risk did you take, guy? I mean, yeah, that's not sustainable. Okay, that's fine. You'll triple your money, and then you'll give it, you'll give 3/4 of it back. That's not in order to become a good trader, you actually have to practice good trading. And it's extremely hard emotionally to have these big swings, good or bad. Okay? So what I'm showing you are options that perform very consistently. And this is the example, and I want to kind of get to it. Remember the two numbers I want you to remember? These are the numbers that we ended up for the year. About 95% winners and about 5.44%. So let's just make it extremely easy to remember. 95% winners making 5% a week. Okay? What does that look like? What does 95% mean to you? Instead of taking 2 steps forward, 1 step back, I want you to go on a walk with me. 19 steps forward. You're going across a football field. 19 steps forward. And then take 2 steps back. Okay? 19 steps forward, 2 steps back. What do you feel at the time you're taking those 2 steps back? Do you feel defeated? No, you're saying, great, here's that loss that I'm expecting to get. You're not looking at that small step back. You're looking forward to the next 19 steps you know that is coming to you. Okay? It's easy to go to work when you don't get beat up by the markets every day. Okay? It's easy to trade every week on Thursday going into Friday because you're bored. You've been playing all for the past 5 days. Now you want to get to work. You get your paycheck on Friday. You feel good about yourself because you know that, hey, chances are this thing's going to work out. And if it doesn't work out on one of the trades, you have a pretty good chance of at least breaking even, if not just making a little bit of money. And then you look at it like, great, that was the loss. Here I go again. I'm going to take those next 18 and 19 steps. That's how you want to trade. That's consistency. That is income. That is something you can hang your hat on that the trade will be there. And I'm only asking $49. I can easily say, that's $490. I will have a line of people want to pay that to get those kind of returns over a year. Because $99 is nothing compared to what you can turn this into. Why $49? Because Value Charts believes that we have an extremely good service, an extremely good way to make money. And if you can do that, you can build confidence in yourself as a trader, generate consistent income for yourself, expand upon that, and actually stay in the market. The majority of traders fail in the market because they blow up their account. If you trade according to these parameters and use the stop losses I give you, then you have to be doing something pretty foolhardy. Okay? But if you can stay in the market to get enough experience to become good at what you're doing, then you can be a successful trader. If you're in the market for a couple of weeks, you trade away and you take all those losses, now what do you do? So Value Charts wants to develop a relationship with you, give you a set of trades that can generate a consistent income. That way you can maybe look to come back to us. Are you going to join the trading room? Are you going to learn how to use this indicator that we use very successfully? Let me learn more about options. Let me learn more about futures. That is the honest answer. We want you to stay in the market so that you can learn and survive, and you can come back to us and see if what else we do. Does it suit you? Does it a good fit? If not, good luck. You'll always have this strategy that you can fall back on. You have a job. You have a trading system that can generate a weekly paycheck. What you do with that, that's up to you. Put it back in your account, spend it on your family, generate a second income. Whatever you want to do, you can do that. Okay? So again, that is the opportunity. I think that it would be very, very well suited for the vast majority of traders. If you have option experience, by all means, you'll be able to pick this up right away. It's not rocket science. It's not some esoteric setup that only happens when it's a blue moon. This is weekly. I've shown you the results from last year. I've shown you the past, this month. Okay, so there's consistency what I'm saying. If this thing didn't work, I wouldn't be trading it in my trading room over 2 years now. So I hope that helps. Let me look at a couple of your questions here. I know I'm running a little bit. How much average cost per trade? That's a good question, Ricker. Here's an example. Okay, let's just look at this week on 5/13. Okay, let's just take this Priceline trade. This is a 1250 by 1245 put. Bullish put debit spread. So we want the price of Priceline to stay above the short strike, which is 1250. Now, because this is a $5 wide spread, you multiply it by 100, so it's $500 per spread, and I have 10 spreads. So this position requires a buying power of $5,000. Now, the premium that I'm receiving for this is $350. So the $5,000 position is utilizing 300. I'm generating $350 by using 5,000. That results in a 7% return. Okay, that was an outstanding trade. It was a unique setup. Priceline gave me the opportunity to take 35 cents. But notice most of the time it's around 20 to 24 cents. This is a 4% return. That's about a 4.8% return. That's a 7% return. If it's a quarter, this is a 5% return. Okay? Most of the time I let them expire worthless so I don't pay commissions twice. But usually it's the case, you set this thing, you forget it, and, in this case, I think the market moved up this week. I actually didn't really look at Priceline or CMG all day on Friday. Why? Because this one was bullish trade. The price actually went up that day. It was green on my screen, so I didn't have to look at it. I knew it was going to expire with 100% profits. Okay? How many options have midweek options? Right now, the CBOE is just experimenting, but we normally do our midweek options on SPX, which is the S&P 500 index. Yeah, SP. I think there are a couple of more, but this is the one with the most volume. That's the one I feel most comfortable with us doing. Well, here's the thing there's a question here. It says, I get scared holding positions that may fail but have higher than realistic probabilities. Probability is actually baked into the option price. Okay? You're not going to no one's going to pay you 35 cents on a spread unless you take the mathematical distance to price probability type computation. Because remember, option and derivative prices are based on a mathematical calculation. But the way we apply what we see on the charts, we actually pick the more favorable setup because we're paying attention to what price is doing. It's almost like there's a second dimension. Mathematically, it's very two-dimensional. Okay, it's this far away, so therefore and these are the other parameters. This is what the actual price should be. Well, you're not taking into account the directional price over on a 60-minute chart. If momentum is very strong, it's not going to. If momentum is strongly bullish, the option price is not necessarily skewed that way because there's no Greek for. What's the price doing? You have gamma, which is the rate of change of delta, but that is still kind of neutral. It's almost like it's a speed number. It's not a vector. This is what we do in our trading room is actually very closely related to classical mechanics. Okay, that we have a lot of. You look at it from a physics standpoint, we have bullish and bearish energy, and you can tell the slope of some of our indicator lines. But the most important thing is for you to know, for these parameters, we take that into account because we give you a checklist. Say, meet these criteria. If this criteria is good, then you take the trade. If it doesn't quite match, then leave it alone. Don't take it. Your strength is that you don't have to take every trade. You can pick and choose the best ones. That's why we only have, some weeks we have 4 or 5, and there's some weeks that we have 2. Here. Oh, these are 4. I think there was a week here we had like one. Here, we had one. Because we couldn't tell. If the market is neutral, we don't like to put spreads on. It's kind of funny to say that, because most people would love to put credit spreads on when the market is flat. Well, first of all, you don't get as much premium, and second of all, you put it on, it could jump up and run away from you, or you could jump up and bite you. Well, guess what? I like to know where it's going, and I run in the other direction. Okay? If the bully is chasing me, if the bully is running north, I want to go south. Okay? I want to know he's moving. Okay? So basically, that's what we have for you. Again, this is the special webinar offer we are offering because, again, we believe that traders need an edge. Okay? If I can give you a tool, a system, a methodology that allows you to have a high probability of success and that you can go through and understand it, you'll find that you have a way to make money in the market. If you're just sitting and you open your account and you look at a chart and you say, I think it's going up, oh, I think it's going down. And then later on next week, you do something else. And then, this way you can trade whatever you want to trade, Monday, Tuesday, Wednesday, Thursday. And then you can put on Thursday at noon, put on the trades, manage it through Friday. Now at least you won on something during the week. Whatever you experimented earlier in the week, that's up to you. So 11-hour options will always be there. Oh, the 11 hours? Somebody asked earlier, how'd you come up with that name? From 12 noon until 4 o'clock at Friday, the market is open roughly 11 hours. It's technically 10 and a half, but the 10 and a half hour option spread strategy sounds kind of dorky. So 11 hour it is. All right, guys, this works on anything. We primarily do it on indexes and individual stocks, the big ones. So I hope you guys take advantage of it. It's been a pleasure to share this with you. I love sharing this strategy. The stop loss directions are in there. Yep. You can use Options Express. I use Thinkorswim. I have traders that use Options Express. I use the platform you use to enter the orders is irrelevant. The techniques are not specific to say, okay, you have to use the value charts indicators. I think they're the best, but you can use this with the moving averages, whatever you choose, charting system, and MACD. It is the system. It is not the indicators. It's the way of thinking that leads you to success. And the checklist and everything required to do the strategies successfully are included here. There's no additional strings attached. Now, if you want to join my trading room, go to valuecharts.com. We can get you into like a $7 30-day trial, and you'd be in there, and you could watch us trade those strategies, and as many times as you want. I think one time in the past couple of years, someone was assigned, but our stop loss levels never get that close. That's correct. DR. We placed 4 trades on Thursday. The minimum size cap of the markets, I prefer big, mainly because like Priceline, Facebook, Amazon, Google. One, there's a lot of volume, and the bid-ask spread is narrow. And because of the large price, you actually get very good striations in where you can write your credit spreads, and that always helps. And then there's also weekly options. That's good. You pick something that's small, you're not going to get good placement for your your short strikes. But it's all outlined in the strategy. If you have questions on like giving value charts a try, go to valuecharts.com. And it's right there. Okay? We'll be able to take care of it. I don't want to go past too much more because I know there's a speaker right after me. So if there's anything else you need, you can always send an email to support@microquant.com. Okay? Support@microquant.com. And again, take us up on it, valuechartstrading.com/11. Okay? Everybody, thank you very much for this evening, and all the best of luck in the markets. Let us know if there's anything you can do. Let me know personally. Be happy to help you. Thanks a lot.